Welcome to the Best Interest Podcast, where we believe Benjamin Franklin's advice that an investment in knowledge pays the best interest, both in finances and in your life. Every episode teaches you personal finance and investing in simple terms. Now, here's your host, Jesse Kramer.
Hello and welcome to episode 95 of the Best Interest Podcast. My name is Jesse Kramer, and today we are bringing you another AMA episode. If you want to, you can go listen to the past AMA episodes, which I believe were all very well received, which were episodes 90, 86, and 81. And before we get into question one today, we are going to start with our customary review of the week. This one comes from NIRAC111. And NIRAC wrote in and said, straightforward, clear, concise language. I stumbled upon this podcast after hearing about it on another podcast. I've listened to more than 5 episodes already. I really like Jesse's presentation style, and I will be listening more. Well, NIRAC, thank you very much for those kind words. If you're listening to this right now, you can email me, jesse@bestinterest.blog, and we will get you hooked up with a super soft Best Interest t-shirt. Okay, let's dive into the AMA. First, question one. Kate wrote in, and Kate's got a semi-long question, but it's pretty good, pretty detailed. So we're going to take our time and work our way through it. Kate's question is about portfolio rebalancing. Kate's in her early 40s. She plans to work another 25 years. She has $650,000 in IRAs. $250,000 is in a S&P 500 ETF. The remaining $400,000 is in individual stocks with a very heavy concentration in tech stocks like Amazon, Apple, and Google. And when Kate was younger, she followed the maxim of buying what she knew, which is something, if you're familiar with Peter Lynch, listeners, he's a famous proponent of buy what you know. And Kate says that those stocks, the stocks that she knew, they've done incredibly well for her over the last 15 years. But now she's getting nervous about having that much money in individual stocks, especially all in the same industry, the tech industry. It's hard to sell those stocks, in Kate's words, when they've done so well for her over the past years. But I know that I need to rebalance or risk tremendous loss. So, Jesse, can you tell me how you would look at this, which is a very good, but ultimately still a problem, a good problem to have? How much of these tech stocks would you recommend selling? And should Kate just keep pouring that money into an S&P 500 fund or diversify into another category? How often would you consider rebalancing? So Apple, Google, and Amazon, they initially started out at only about 20% of Kate's portfolio, but they've grown significantly over the last decade. Do you consider rebalancing on a regular schedule? Is there a point in time when the more conservative portion of your investment account is high enough that you just let the individual stocks ride? Kate also included that she's a government employee and she's on track to retire with a pension that will be north of $75,000 a year, so she can afford to be a little bit more risky in her IRAs. Fantastic question, Kate. So first, rebalancing inside of IRA accounts and other qualified accounts like a 401k or an HSA or something like that has no tax consequence. And that's wonderful. That's a great thing for you. You don't have to fret about capital gains taxes in this case, even though the stocks that you've picked have increased so much. Yes, there are capital gains there, but you don't have to pay capital gains taxes on anything inside of a qualified account. So that would be different if the investments were in a taxable brokerage account. I know later in today's episode, we have a question about taxable brokerage accounts. I'll address that idea in a minute. Quite simply, Kate, the easiest diversification method would be to sell those individual stocks completely and then buy a total market index ETF. That's the simple answer. But okay, you mentioned Apple, Amazon, and Google. So I'll think about those. I'll use those 3 companies in this example. Let's look at VTI. That's Vanguard's Total Stock Market Index ETF. That fund is composed of obviously many different companies, but 6% of it is Apple, 3.3% of it is Google, 3.4% of it is Amazon. In other words, you'll still have plenty of exposure to those same exact tech companies inside of VTI. You won't necessarily feel the daily ups and downs of those individual names. I would say many of us listening right now might own an index fund or just some sort of diversified mutual fund. And we're blissfully unaware of the fact that on any given day, some of the stocks that we have ownership of inside that fund, they're losing money. They're down on the day. We don't know it because maybe the fund on the whole is up. But anyway, so that's just part and parcel of investing in a diversified fund or investing in a mutual fund like VTI. Now, Kate, if you feel a particular emotional connection to those companies, to Amazon and Apple and Google, and you don't want to abandon them completely, I get it. That's very, very common. And in that case, I would recommend you carve out a small portion of your investable dollars and make that small portion your sandbox that you get to play in. How big is that portion? It might be 3%, it might be 5%, maybe it can get all the way up to 10% of your investing dollars. That's probably where I would cap it, is at 10% of your investing dollars. That can be your sandbox. And within that sandbox, if you want to own just Apple, Amazon, and Google, so be it. That's fine. That's fine. So 90% of your investing dollars will end up in a diversified, low-cost portfolio. The other 10%, that can be your sandbox where maybe you take more risks, you hold single stocks, you have a little bit of fun, you own individual companies that you know, companies that maybe you don't understand their balance sheets, maybe you don't understand the true intricacies of their business, but you're familiar with the brands and there's something interesting, fun about owning brands that you're familiar with. Okay, let's go to the other part of your question. I recommend you create a rebalancing rule that works for you, that you can stick with through thick and thin. And there are a couple ways to approach the rebalancing rule. One of them is very much time-based, where someone says, I rebalance every 3 months or every 6 months or every 12 months, no matter what. There's a reminder on my calendar, and it's time-based, it's date-based, that on certain times of the year, whether the market's gone up or gone down, I am going to rebalance. Or there's another type of rule where someone might say it's not time-based, but it's allocation-based. They might say, if my allocation gets more than 5% out of whack, then I rebalance. So let's say you start at a 80-20 allocation. Well, in that case, you're going to rebalance if you get to 75-25 because you're 5% out of whack. Or if you get up to 85-15, then you're going to rebalance. And that target 80-20, right, is like this gravitational pull or like this bungee cord that's going to pull you back in as soon as you get too far out of whack. You go back to your target allocation. So the first type requires you to bake in rebalancing into your calendar. The second type requires you to keep tabs on the portfolio itself. So is one of those two rebalancing strategies better than the other? Not necessarily. I mean, I suppose when it actually comes down to brass tacks and numbers, yes, I'm sure someone out there has done research and there are differences between the two. In fact, I do remember reading something that the allocation-based rebalancing tends to be better than the time-based rebalancing. Although, in my opinion, I think just from the human behavior point of view, I would think that the time-based rebalancing is just easier, right? It's easy to say, yeah, on June 31st and December 31st, every 6 months, I rebalance my portfolio. And for what it's worth, I think the differences between the two rebalancing strategies are slim and small enough, very small differences and small benefits, that either one you choose is going to be helpful and is going to be better than doing nothing at all. So that, listeners and Kate, I would leave that one up to you, yourself best, what works for you best. But Kate had another part of her question. Is there a point in time when the more conservative portion of your investment account is high enough that you just let your stocks ride? And yes, there is. I'm going to link an article in the show notes that I called. The title of the article is When Not to Rebalance. And in short, it goes back to a couple fundamental ways to construct a portfolio. One way to construct a portfolio is to measure strictly in percentages, based on your ability to take on risk, based on your willingness to take risk and your need for the returns that come from risk. Let's say you settle on a 60-40 portfolio. Great. That's your target. You're measuring in percentages. And whenever the portfolio strays too far from those percentages, you're going to rebalance, right? Or whenever your 6 months or 12 months date comes up, you're going to rebalance back to, in that example, 60-40. But the second way to construct a portfolio is more about timelines and goals and building a certain amount of buffer into your portfolio. That kind of investor might think to themselves, you know what? I always want to have 10 years worth of spending sitting in low risk US bonds inside my portfolio. I'm not thinking about 40% of my portfolio. I'm thinking about 10 years worth of spending in bonds, right? It's not a percentage. It's a dollar amount. And so for that investor, they will probably reach a point in their investing career where the bonds in their portfolio continue to cover their 10-year need and their stocks are continuing to grow far beyond their original investment. So what might have started as 60-40 just because 40% happened to be 10 years worth of spending for them, maybe it now becomes 70-30 because, well, their portfolio has grown and now only 30% of it is needed in bonds to cover 10 years worth of spending. It's not that the bonds have shrunk. In fact, it'd probably be that the bonds are just the same exact size that they were when they started. It's just that the stock growth is far outpacing the bond growth. Now, I'd argue that as long as that investor is still comfortable in their financial plan with the idea of holding 10 years of bonds, then yeah, I don't think they need to rebalance in that case. So it's important for each of us to understand the reasons, the rationale behind our chosen asset allocation. Your need to rebalance to that allocation will depend on the reasons that you chose it in the first place and the current state of your portfolio. And in some cases, it means a change in your portfolio will lead to rebalancing, right? The natural forces of the market will lead you to rebalance your portfolio. But in other cases, maybe your portfolio can be changing beneath your feet, and that's perfectly fine because it's still doing the thing that you need it to do. In this case, you might still have the right amount of bonds that you need to reach your long-term goals. And in that case, you can let your portfolio ride. At least you don't always have to rebalance it. So thank you for the great question, Kate. Question 2, Dan C. wrote in and asked, Jesse, I'm hoping to get some clear-headed Jesse thinking here. You and another financial planner encouraged me to buy bonds. I'm involved with Vanguard and Fidelity, so I looked at Vanguard's VBTLX Total Bond Market Indexed Admiral shares. It states that the average return after taxes on distributions was low single digits or even negative performance over 1, 3, 5, and 10-year timelines. Since October 2001, that fund, the Vanguard Total Bond Market Index Fund, has returned an average of 1.8% per year. I also looked at Vanguard's Long-Term Corporate Bond Index Fund, recommended by Morningstar, and after taxes on distributions, that one's returns are even worse over the past 1, 3, 5, and 10 years, and since inception, it has returned 2.8% per year. I'd like to see that performance laid out against inflation and as a hedge against falling markets. I don't see how choosing bonds or a bond fund can help. It looks like there would be a large loss. So I haven't moved forward with bonds until I can figure out why the experts are recommending them in the first place. What am I missing? What am I not understanding? Am I reading the wrong chart or in the wrong way? Dan, what a phenomenal question. Another great question. And there are 2 big issues that I want to address here in the answer. The first one is part of your question, why the negative performance in bonds, or just why the bad performance in bonds, especially compared to stocks. And then the second part of your question, are bonds good against inflation, or how should we think about bonds and compare them to inflation? So as far as the negative performance goes, so listeners, you might be familiar with this already, that bonds are quite sensitive to interest rates. And the longer the bond, a 30-year bond versus a 1-year bond, generally the more sensitive that bond is to interest rates. That goes into this term called duration. If you hear the word duration with bonds, it doesn't quite mean what's the length of the bond, 30-year versus 1 year. So it is a bit confusing, but it's related in a way. Duration really is a synonym for interest rate sensitivity. Now, okay, but why does this matter? Why are longer bonds more sensitive to interest rates? Or simply, why are bonds sensitive to interest rates in the first place? So let's say you own a 30-year bond or any year bond. We'll just use 30-year bond, and it's yielding 2% per year. Well, right now, you can go to the U.S. Treasury and buy a bond at probably 4.5%, something like that. I'm not sure what the 30-year yield is off the top of my head, but the idea is if you own a 2% bond and you're trying to sell it on the open market, but I can go to the Treasury and buy a bond at 4%, why the heck would I want your 2% bond, right? So the only way you could entice me to buy your 2% bond is if you lower the price so much that rather than spending $1,000 at the U.S. Treasury to buy a 4% bond, I'm going to pay you much, much less to buy your 2% bond, so much that the effective rate of return in the long run would be the same for me, right? Because at the end of the day, when a bond expires, at the end of the day, you get all the money back that was originally used to purchase the bond. So in that way, it is a little confusing. I do admit that, but bond prices are very mathematical, right? Because your 30-year 2% bond and my 30-year, call it 4% bond, we each spent $1,000 up front. But if I'm getting all this extra return, 4% versus 2%, well, I'm certainly not going to pay you $1,000 for yours when I can go buy a new one for $1,000 at the Treasury. So I hope that makes sense. And the interest rate hikes that we saw in 2022 and 2023, essentially what that did was it took all these people out there who owned bonds that they maybe bought in the 2010s or the early 2020s that were paying 1 or 2%. And now all of a sudden the Treasury is selling bonds at 4 and 5%. And what did we just go over? Well, the price of your existing bonds would have dropped quite suddenly. And that's why, Dan, when you see those bond funds that you're looking at on Vanguard or Morningstar or wherever you're looking, that explains the negative performance. If we zoom out further, we do see that the 2022 and 2023 interest rate hikes and the bond performance in those years is fairly anomalous. and that generally bonds do provide a slow and steady long-term return. And there's another note here, another very important note for what it's worth, because this is a mistake that I see all the time. I see it, sometimes I'll see it when a client asks me a question, but way more often than that, I see it online, right? I see it in the Facebook groups, the Reddit groups, the places where DIY investors and DIY financial planners talk with one another. And the mistake is that we need to be very careful with bonds and bond funds about looking at their prices versus looking at their total returns. We need to be very careful here because a bond by its very design is supposed to be relatively stable in price while providing a coupon or an interest payment to the bond owner. So for example, if you pull up the chart for one of the funds that Dan mentioned, the Vanguard Total Bond Market Index Fund or VBLTX, you can see that the price was $10 per share in 2001, and it's about $9.60 per share today. That's 23 years, and the price has actually gone down, right? It's basically flat, but it's even a little bit negative over 23 years. And to those of us who understand, say, what the stock market has done over the last 23 years, we think, what a travesty. And well, the thing is, price alone simply doesn't suffice here. That's the fundamental error. And as fundamental an error as can occur for someone who's looking into their own investments. So make sure you don't do this. And the reason why is because that price data, it doesn't show the coupons or the interest payments that VBLTX has been providing to its owners over the last 23 years. And that's where all the return on bonds come from. So I went and pulled data on a couple total market bond funds. For what it's worth, I couldn't find the data on VBLTX as it's a mutual fund, and the site I was looking at had very, very detailed data on ETFs, not on mutual funds. So that's what I'm using here. But essentially, the two ETFs I'm looking at are proxies for VBLTX. One of them is called BND, as in bond without the O, and that's Vanguard's total bond ETF. And the other one is called AGG, which is the iShares version of the Bloomberg Aggregate Index. So they're both index fund ETFs with mission statements of tracking the Bloomberg Ag, which you can kind of think of as the total bond market. So if I look at price alone, right, I'm only looking at price, not total return. I'm making the mistake here. I would see that the Ag is down 4.8% over the last 21 years, 4.8% in total over the last 21 years. But if I include interest payments from Ag, which again, that's the whole point of owning a bond in the first place, we see that the Ag is actually up 2.9% per year, or 83% in total over the past 21 years. A very similar story for BND. BND was created in 2008. It's also down about 4% on price over the last 16 years. But if we look at total return, it's up 57%, or about 2.7% per year over those 16 years. Granted, if we held those bonds in a taxable account, then the interest we receive is taxable, and those taxes do eat away at our long-term returns. So I think that's probably where Dan is getting some of the after-tax numbers that he quoted in his question. They sound quite accurate. I did some back-of-the-napkin math, assuming a 25% marginal tax rate, blah, blah, blah. And yeah, it drops the annualized returns from roughly 2.7% per year down to about 1.8% per year. That's a big difference. And for what it's worth, that gets into a nuanced topic called asset location. Some of you might be familiar with that. It's another way of saying not only what are you investing in, stocks, bonds, blah, 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 but which accounts are housing those assets. Your IRA, your 401k, your taxable account. Now, personally, I'm not a huge proponent of allowing the tax tail to wag the investment dog, because sometimes paying taxes on positive returns, it's simply part of this investing process, and it's a sign that your investments are performing pretty well for you. But all else being equal, why pay more tax than you have to? So asset location is a good concept to know there. But getting back to the main point of this little diatribe, price, when it comes to bonds, price is not the metric of merit. And even when it comes to stocks, price is not the metric of merit, right? Because stock prices don't include dividends. The dividend is gone. The price has gone down. Well, it's still part of total return. And that's why total return is the metric of merit, which, by the way, it includes both the price return and it includes the interest or the dividends that are being paid. As a side note, longtime listeners will have heard me rail against the baloney reasons why some people cling to the idea of dividend investing. Yes, dividends are a great thing, and they are part of the reason why we invest in stocks in the first place. But some people would rather own, say, a 7% dividend-paying company whose price never changes, instead of owning perhaps a non-dividend payer that grows by 10% per year. It's just terrible logic. There's nothing magic about dividend payments. Anyone who tries to claim or sell you otherwise, they have a fundamental misunderstanding of the math, or they simply don't understand how businesses are run. They don't understand how the stock market works. It might be all three. If you're listening right now and you've been sold this idea that dividend investing is magic or is some sort of superior way of investing in stocks, I highly recommend you dig into some research or just dig into some common articles that have been written. I'm happy to link mine in the show notes. I think you need to avail yourself of that misconception. All right, now for the second part of Dan's question, which is about inflation. And specifically, Dan had a question about whether bonds can or should be acting as some sort of inflation hedge. Where Dan was asking, why would I hold long-term bonds if bonds lose value to inflation over time? And the answer, quite simply, Dan, is that bonds are not a hedge against inflation. In fact, quite the opposite. Bonds are heavily affected, heavily subject to the forces of inflation. With a bond, you are lending money to someone today in exchange for a fixed amount of money in the future. And what does inflation do? Well, it reduces the value of fixed amounts of money in the future. Yikes. So it can be very risky to say, okay, here's $1,000 today. Please give me $1,000 back in 2034. That's a risky proposition because who knows how much $1,000 will be worth in 2034. So yes, it is nice to receive the coupon interest payments along the way, right? That's the whole point, or that's the whole value proposition of a bond in the first place, is that we get this dependable interest stream as long as we hold the bond. But who knows if those interest payments will be worthwhile as we wait for our principal payment to come back to us. So again, inflation is the enemy of bonds. And that's why for most individuals and families planning for their investment lifetimes, we don't want to give inflation the opportunity to eat away at our bond returns. And that means bonds should be thought of as a shorter term asset than, for example, stocks. So what are bonds good for instead? Well, bonds provide a much higher guarantee over short periods of time as compared to stocks. And they provide a slightly higher return than straight up cash. So if you need money in the next 2 or 4 or 6 years, bonds likely make more sense than stocks or cash in that scenario. Once maybe you get out to 8 or 10 years down the line, and we can look at historical backtests and we can see that the probability of stocks exceeding bond performance over that kind of a time period really starts to slant in our favor, then those are the time periods where stocks really start to make more sense than bonds. What else are bonds good for? Well, bonds provide ballast, which can be important and appropriate for more risk-averse investors. From experience, it can be scary for people when 90% of their assets are in a 30% drawdown. If you have like a 90-10 portfolio and that 90 represents your stock allocation, if the stock market drops 30%, well, that's pretty scary. That means your portfolio is really feeling it. If instead, only 60% of your assets are in drawdown and the other 40%, which are in bonds, are actually up, well, that can lead to a much better investing feeling. And even if the long-term numbers would push you toward more and more stocks, a big risk, possibly one of the biggest risks that any investor faces, and I'm glad I don't think I'm alone in saying this, it's the risk that along your long-term investing journey, something is going to buck you off the horse. Something is going to make you feel so upset, frustrated, scared, stressed that you are going to abandon your investment plan. That's one of the biggest risks that we all face. And one of the ways we fight against that risk is by making sure there's enough conservatism in our plan and enough conservatism in our portfolio that we don't subject ourselves to those kind of negative feelings that would buck us off that horse. So the idea there is designing a portfolio that you can stick with through thick and through thin. That's of ultimate importance. And we need to ask ourselves on a personal level, what is that portfolio? What is that asset allocation that we can stick with through thick and thin? Bonds often play an important role in that conversation. Another way of thinking about the point that I just made is I can go to some of my clients who like to think of things this way, and I can say, hey, Bobby, you have 8 years of future spending safely allocated in bonds. And yes, it stinks that here in the current moment, let's say the stock market happens to be down and your stock portfolio lost $100,000 from where it just was a month ago. That stinks, but we got to zoom out. You still have 8 years worth of spending in bonds, which means you have 8 years before you have to worry one little bit about selling your stocks. So do you believe that 8 years is enough time for the market to rebound from this current drawdown that it's in? Some worried investors, they need that kind of cushion in their portfolio to stick it out. And for some investors, it just really helps them to think about the amount of time that their bonds are buying them, where they can stick it out, they can wait for the stock portion of their portfolio to recover. Dan, thank you for the great question. Again, the topic of bond returns to making sure we're looking at total return, which includes interest payments and possibly includes taxes that you've paid, not just looking at the price of the bond or the bond funds alone. And yeah, bonds should not be thought of as a hedge for inflation. In fact, probably the biggest risk to owning bonds is the inflation risk. So if anything, I mean, it's just a reminder of why bonds are generally a shorter term, stable asset, a ballast of the portfolio. You aren't looking for long-term growth from bonds, from bond ownership. So thank you, Dan. Here's a quick ad, and then we'll get back to the show. Did you know my written blog, The Best Interest, was nominated for 2022 Personal Finance Blog of the Year, and it's been highlighted in the Wall Street Journal, Yahoo Finance, and on CNBC? I love writing, especially when that writing is to share financial education, and I usually write 1 or 2 articles per week. You can read them all at bestinterest.blog. Again, the web address is bestinterest.blog. Check it out. Question number 3 comes from Peter G. Peter says, I hope all is well. I appreciate all the great content you provide. I know the conventional wisdom on Social Security is to wait for the maximum lifetime benefit. However, doing the calculations on online calculators, when I enter my information, I get much better long-term outcomes by taking Social Security earlier and reducing my portfolio withdrawal percentage. Using the Open Social Security app, I come out $60,000 ahead on the Social Security axis by waiting until age 70 rather than taking it early. But if I claim Social Security earlier, then my investment portfolio would end up $1 million higher than if I claim at age 70. In other words, would I rather receive $60,000 extra in Social Security or have $1 million extra in my portfolio? It's a no-brainer. For this analysis, I was using a 40% stock, 40% bond, 20% cash portfolio with various withdrawal rates and different amounts saved, early claiming of Social Security won each and every time. I'd like to know your thoughts on this, Jesse, and if I'm missing something. Thank you. So, very cool question, Peter. That's an awesome question. And here's the first thing. Peter's question inspired me to put some of this down in writing, because sometimes it's just easier to show the numbers in writing, right, than it is to talk through a microphone. So I think you listeners should go read an article I wrote. We'll link it in the show notes. It's called, Why Can't I Take Social Security Early and Invest It? So again, the link will be in the show notes. The heart of the question is that an investment portfolio might be able to return 7 or 8 or 9 or 10% plus per year. Who knows, right? It can vary over time. But an investment portfolio might be able to provide a really strong return over a long period of time. And meanwhile, the benefits of waiting on Social Security, especially in the early years, only increase an individual's monthly payments by 5 or 6 or 7%. Or if we look at the internal rate of return on waiting to claim our Social Security, that IRR might only be, 4, 5, 6%, something like that. And so just from that kind of zoomed out point of view, the math does scream at us and it says, well, duh, if you can get a 9% return on a 60-40 portfolio over a sufficiently long period of time versus a 5 or 6% IRR from the Social Security Administration by waiting, well, then you'd be a fool to choose 6%. Just take your Social Security as early as possible, invest it in your portfolio, and get the higher return. And if we zoom out on Peter's question today, and the question that inspired the article I just mentioned, well, of course, that math makes sense. With sufficiently high investment returns, you should always invest as early as possible. Even if the benefit of delaying Social Security was 20% per year, but I had an investment that was paying me 40% per year, well, I'd rather start collecting as soon as possible and get the money invested in the higher yielding investment. So given sufficiently high returns, you always want to start compound growth as soon as possible. But there is an all-important flaw in this line of thinking. And it's not subject only to Peter, because this is a flaw. I think every time this question comes up, because I saw this question come up last week on Reddit, and I chimed in with an answer. Every time this question comes up, it's coming up because of this flaw. The flaw is that we need to return to the foundational pillar of investing, and something we repeat pretty often here on The Best Interest, that risk and return are intrinsically connected. That returns are not free, but instead that returns are compensation for taking on investment risk. So whenever an investor compares returns alone without also comparing the risks involved, they've conducted an incomplete and an incorrect and a flawed analysis. Peter's question today, it's a great question, but it only looks at returns. It doesn't consider risk. This is the reason for this concept in the investing world of risk-adjusted returns, because comparing only the returns of two investments without dividing in some way by the risk that we've taken, it's not an apples to apples comparison. We just answered Dan's question about bonds. We talked about bonds and stocks. Well, if you look at the long-term returns of stocks and you look at the long-term returns of bonds, why would you ever own bonds? Stocks always outperform bonds in the long run. Well, the reason why bonds make sense is when we think about it through a risk-adjusted lens, and we think about, especially over short periods of time, the probability, the odds that stocks actually lose us money versus the odds that bonds lose us money. And if we're planning for some short-term goal, can we afford to take on that kind of risk? So anyway, that gets us back to that idea of risk-adjusted returns. So in order to make a sensible comparison here in Peter's question about Social Security, we need to level the playing field in terms of risk. The benefits of delaying Social Security, they are guaranteed by the U.S. government. That's a very low risk. We can get into a debate if you want about how low of a risk it is with the state of the U.S. government fiscally and all that, but we need to ask ourselves, what kind of investment risk do we compare the risk of the U.S. government to? I see two viable options. The first one, why does Warren Buffett invest all of Berkshire Hathaway's extra cash into U.S. Treasuries, short-term U.S. Treasury notes, instead of into, say, an S&P 500 index fund? Doesn't he know that the S&P has a much better long-term return, blah, blah, blah? Well, the answer is U.S. Treasuries are as risk-free as anything in the investing universe, backed by the full faith and credit of the U.S. government. So as long as Uncle Sam pays his debts, U.S. Treasuries are risk-free. The S&P is far from risk-free, and Warren Buffett knows that. He wants his cash to be safe and ready for deployment at a moment's notice. The S&P 500 cannot fulfill that need. So the first logical comparison today, then, is to use a true risk-free rate as our investment return. Something like a high-yield bank account or a short-term U.S. Treasury note is appropriate for that. Conveniently, we did that analysis in the linked article in the show notes, where our conclusion ends up being no different than traditional Social Security advice, which is to say that the break-even point, which is the point at which collecting late makes more sense than collecting early, or the point at which the different ages that you can collect Social Security, they kind of converge at a single age, that occurs in the late 70s. And what I mean by that is if someone lives beyond their late 70s, they will have wished they collected later in life. If someone passes away before their late 70s, they would have wished that they started collecting Social Security as early as possible. That's the break-even point. And even when we throw this investing question into the analysis like we're doing today, if our investment return is the risk-free rate of return that you can get from a high-yield savings account or from a U.S. Treasury, well, then the break-even point still occurs in the late 70s, which is the same as all traditional Social Security advice that tends to be given. Now, the second option, the second way to approach Peter's question is to show the potential downsides of Peter's analysis. So that is, it's to show how higher returns from a stock portfolio, if they work in your favor, I'm sure, and the math shows it clearly, that if stock market returns work in your favor, you will have wished that you started collecting Social Security as early as possible. So you could either put that money to work in your portfolio, or you could reduce your withdrawals and therefore keep more money in your portfolio, right? The math is exactly the same if we think of it that way. The point being, if you start withdrawals earlier, more of your money is at work in your portfolio, compounding at a higher rate of return, and that ends up being better. But the second thing we're going to do right now is to show the downside of that type of analysis, which is to show how higher returns from a stock-based portfolio, they're far from a guarantee. More specifically, we can show how the downside risk of a portfolio could actually turn this result on its head. What happens if we suffer a bad market, if we have bad market timing, if we have a bad sequence of returns during our early Social Security period? So in the linked article, we looked at a traditional 60-40 portfolio, looked at all the historical returns of that 60-40 portfolio, as in, the actual returns that portfolio would have given an investor since 1950. It had multiple 10-year periods with returns below 2% per year. What if we started our Social Security timeline with that kind of low return? And then even if we said, let's be holistic here, let's make up for that return at the end of the analysis. So let's start with a pretty bad return, and then later on in life, let's assume we had pretty good returns. What does that do to the idea of collecting Social Security earlier? The results are that the 60-40 solution, if you will, or just the idea of collecting early and investing it, that solution comes with very large risks. Our early Social Security hack only worked in this particular case if our retiree died before age 75. That's not a good outcome. Doubly so if Social Security ends up being a safety net or a backstop in your financial plan. If something like this were to work, we would want to see data that shows that, we can start collecting Social Security at 62, And even if we live till 85, 90, 95, that still ends up being the smarter choice than waiting until age 70 to start collecting. That's how Social Security analysis, that's kind of the metric of merit here, is what age would you have died at for this particular choice to have made sense? So maybe I didn't explain that perfectly clearly before, but that's the helpful way to think of it. And all traditional Social Security advice shows the break-even points occurring, in the late 70s. What Peter's proposing here are just the idea of collecting Social Security early to invest it. If markets go through a very realistic, somewhat negative sequence of returns that we've seen before here in this world that we live in, what we see is that the break-even point drops down to age 75. And that's a bad thing. That's a negative. That's very much a negative result. So if Social Security is play money, if it's just for fun money in your financial plan and you're okay with risking a loss, I can see the merit and the appeal of Peter's question today. You can apply for Social Security early, you can invest it reasonably, and as long as markets cooperate, which to be fair, they tend to do, and that's the whole reason why we invest in the first place, as long as markets cooperate, you will be better off for it. But it's no guarantee. And that's the entire point of the Social Security system. It's to provide a guaranteed benefit to retirees. So if Social Security and the guarantee that it provides is playing even a minor role in your financial plan, I would strongly discourage putting that money at investment risk simply to eke out extra investment returns. When we make a level playing field comparison by using a risk-free rate, like we did today, whether it was the short-term treasury note or the high-yield savings account kind of returns, we see that there is no net benefit to taking Social Security early and investing it. The only possible benefit comes when we put our Social Security dollars at risk. And of course, if we're going to take on such a risk, we better have better looking numbers at the end of the day, right? That's the only logical result that would make us feel good about taking that investment risk in the first place. So Peter, for your specific scenario, I would ask yourself, how vital are Social Security dollars to your long-term financial plan? If it's the kind of thing where you know you're going to be okay without it, even if Social Security disappeared, you'd be fine without it, then I could understand your desire to take it early and therefore decrease your withdrawal rate from your portfolio. But if you're listening right now and you know Social Security is going to be important for your financial future, I would highly recommend hesitating, double-checking your numbers, looking really deeply at your plan, asking your financial planner, whatever it may be, before you make a decision like collecting early just to make extra investments. Question number 4 today comes from Lucas. Hey, Jesse, I hope you're well. I just recently found you after you were a guest on Stacking Benjamin's podcast, and I've been listening to your AMA episodes, which I find enjoyable and helpful. I've got a question I was hoping you could answer here on your show. My wife and I are in our early 30s, and we're shifting our focus to filling out our taxable brokerage with all our extra funds because we have our house paid off. We maximize our 401ks and backdoor Roth IRA contributions throughout the year, and we usually have anywhere between $4,000 and $6,000 left over each month to put into a taxable brokerage, which we just started this year. What are some things I should be on the lookout for or take into consideration? We do reinvest dividends, and I know we'll need to pay taxes on those and any distributions, but is there anything else I need to account for? Thanks and keep up the good work, Lucas. Lucas, thank you for tuning in and congratulations on what sounds like a fantastic situation you find yourself in. You've got a paid off house, you're maxing out your retirement accounts, and you still have another $4,000 or $6,000 per month to save and invest. I believe that's what they call a not to brag moment, but seriously, kudos to you. Okay, here's some food for thought for you on those taxable accounts. To answer your direct questions, yes, you'll want to have a plan for reinvesting dividend payments. Good for you. It sounds like you have that, which is true for just about any other account you own. Usually that means a simple dividend reinvestment plan or DRIP. It's usually like a toggle or an option. For those of you listening who are unsure what I'm talking about, it's a toggle or an option on the account itself. So when you log into Fidelity or Vanguard or wherever, and you can just toggle this on to automatically reinvest any dividends that are paid for you. That is almost always a good idea. And yes, Lucas, you'll need to pay annual taxes on any interest or dividends you receive in this account. So that might be the first thing to be aware of, Lucas. As your taxable account grows in size, and as your interest and dividends also grow in size, there might come a point actually where you're earning so much interest and dividend income that it's actually going to be a reasonably sizable portion of your overall income pie. And you're going to have to do one of two things. You'll either have to increase the amount of tax withholding at your day job, or you'll have to make quarterly estimated tax payments. So let's spend a couple minutes on that quick aside. What are quarterly estimated tax payments and why do we need to pay them? First, it's important to establish that the U.S. tax code expects us, the taxpayers, to pay in throughout the year. It's a pay-as-you-go system. It's not a pay the whole bill next April system. And for most of us, that means we pay into the tax system every single time we receive a paycheck. That's called your withholding. You can see it right there on your pay stub. We've all seen it or felt it in our own lives. But now we need to ask ourselves, what happens when we receive income that does not have that kind of withholding set up? That's exactly what Lucas or any of us with a taxable brokerage account, that's what ends up happening to us. We're receiving dividend or interest income. We don't necessarily have tax withholding set up in those taxable brokerage accounts. Well, the answer is that the IRS still expects us to pay as we go. And we can't get away with waiting until next April to pay that tax bill. So for situations like that, the IRS has 4 quarterly deadlines where they establish that deadline to receive an estimated tax payment from us, the taxpayer. Typically, you would work with your accountant to calculate and submit your estimated tax payment. Now, the IRS understands that nobody is perfect, and some taxpayers will end up owing a little bit of money when they file taxes in April. And that's not because you avoided the pay-as-you-go system. It's just that you didn't quite pay enough as you went, as it were. However, so that's why the IRS does have a 90% threshold at which they draw the line. As long as you paid as you went, a total of 90% or more of the taxes you owed, you are safe. Or the alternate is, as long as you paid as you went the full amount of taxes you owed in the previous year, then you're safe. And a quick example, just to make sure we're on the same side here, because taxes are confusing and this logic is confusing. Here we are recording in November of 2024. So let's say last year, 2023, let's say my total federal tax bill ended up being $20,000. And this year, 2024, well, I don't know what my tax bill is going to be. Maybe my total tax bill is going to be $30,000 for whatever reason. So I kind of have 2 choices there. Either way, I need to pay as I go throughout the year. I need to make sure I'm paying into the system. And the IRS really has 2 different benchmarks that they're going to compare me against. The first one is I either need to make sure that I pay as I go the full amount of whatever I owed them last year, which was $20,000. So that's the first barrier that I can try to get over. Or I can think about the year as it goes along. I can try to estimate what my total tax bill will be by the end of the year. And I need to make sure I pay in at least 90% of that. Now, in this hypothetical I just set up, I was saying that my tax bill this year is $30,000. 90% of that is $27,000. It's going to be easier for me in this case just to make sure that I put in the full amount that I owed last year. So the IRS will expect me, come the end of 2024, that I paid as I went $20,000 throughout this 2024 year. That's how that system works. If you pay less than one of those 2 thresholds that we just described, you will be subject to a small fine for lack of timely payment. It's an annoying thing that you don't want to have to deal with. So Lucas, as you're just starting out, this is probably going to be a non-issue for you because your income, your interest income, your dividend income is going to be so small compared to your W-2 income and the amount of withholding that you're already taking. But if you eventually reach a point where your taxable account is shedding off lots of interest and dividends, enough so that it's a good percentage of your total take-home income, then you'll definitely want to ensure that you're either making estimated tax payments or, what might be easier, is adjusting your workplace withholding from your normal paycheck, adjusting that higher so that you pay as you go more throughout the year. Let's talk about your investment strategy, Lucas. First, I'd ask if you have any specific goals for your money. Are you saving for a boat, for a lake house? Are you investing just because, you just want to put that money to work? As always, if you have specific goals with specific timelines, you can and should construct your portfolio based on the dollar amounts of those goals and the asset classes that make sense for your timelines. But what if you don't really have any specific goals? What then? Well, I'd maintain that your taxable account should be slightly more conservative than your retirement accounts. And again, it comes down to timelines. Because even though you might not have a goal set for your taxable investments right now, and you might be thinking in your head, well, there's an indefinite timeline there. It's a super long timeline. I'm going to go high risk. There's always a chance that that changes in the future. I can say from experience of working with clients who on day 1 said, yep, we're just investing for the long run. Just put it to work, long-term assets. Then a couple years later, they came back to me and said, well, actually, we're going to give $30,000 to our kid for a home down payment. With a taxable account, you can pull the money out at any time. For 90% of people, including me, perhaps including you, I think it helps to look yourself in the mirror and say, you know what? Life changes, curveballs happen. My goals for this money today might change in the future, and I might have a sudden timeline shift that I wasn't quite expecting. Allocating this taxable account in a slightly more conservative manner as compared to retirement accounts is acknowledging that very human truth about ourselves. So I would consider that, Lucas. The next topic, capital gains. If and when you eventually sell assets in this account, Lucas, you will be subject to capital gains and capital losses, well, hopefully more gains, and the subsequent taxes that come with that. Capital gains tax planning, it's a very fun financial planning topic. Timing is everything here. If you end up realizing capital gains while you're still earning lots of income, like from your normal W-2 job, well, you're definitely going to pay taxes on those gains. If you can wait until low earning years, such as retirement or just something else that happens in life when you have a low earning year, I don't know, maybe you'll have a sabbatical, something like that, you can probably avoid quite a bit of capital gains tax. If you're charitably inclined, you can avoid quite a bit of capital gains tax. You can also look into tax loss harvesting, which coincidentally is a common end of year topic. Here we are in November of 2024. Even though it shouldn't really be an end of year topic, it shouldn't be based on the time of year at all. Tax loss harvesting should only be based on market performance. That's an aside for another day. Anyway, there might not be many tax losses for you to harvest here in 2024, Lucas, or anyone listening. In general, assets have performed very well this year. But on that topic, tax loss harvesting, it's an okay, but certainly not an outstanding tool in the toolbox. I'll share my thoughts via an article I wrote. The link is in the show notes. Is tax loss harvesting worthwhile? For those curious, the short answer is the way most people use tax loss harvesting results in zero net change in their portfolio construction, right? They're selling one stock or one fund to buy a very similar stock or a very similar fund. So it's not like they're achieving a better asset allocation or better diversification. There's no change there. But also the way people, at least the way most people use tax loss harvesting, also results in no net change in the cost basis of their portfolio. They realize some losses today, and they reinvest the money, which that lowers your cost basis, right? You're selling an asset that had a higher cost basis. You're selling it for a loss. You're buying back in a different asset, which presumably has a lower cost basis. So on that side of the equation, you're lowering the cost basis of your portfolio. And then you're offsetting that by realizing some gains and reinvesting that money too, which raises the cost basis on that side of your portfolio. The losses offset the gains, resulting in no net tax this year. Great, that's fine. That's kind of the idea of tax loss harvesting. But what do we actually accomplish? The cost basis of your portfolio is exactly the same as it was before. You lowered it on one side, you raised it on the other side. All we did in this case was kick the capital gains taxes down the road, which has a small, minor benefit of doing that, but it's not nearly as good as most people think. Now, there are some interesting cases where tax loss harvesting is extremely worthwhile, but usually it has to do with offsetting the tax gains from some other type of investment. Usually it might have to do with a real diversification play that also provides tax benefits. So here's an example. Let's say a retiree is downsizing their house, and the home sale results in a large amount of taxable gains. Now, many of those gains are actually going to be tax exempt as it was their primary home, but let's say there's still another $100,000 in gains, resulting in about $24,000 in federal taxes for them. Well, if that individual has a taxable account with any sort of losses in it, I would definitely recommend running the math on if those losses can be realized to offset some or all of the gains from their home sale. That's a great use of tax loss harvesting because the gains from the home sale are there. They didn't sell their home to adjust their asset allocation. They sold their home because of just life in general. And yeah, those gains all occurring in 1 year might not be a very good thing for them. And if they can offset those gains with some losses, that might be a great net benefit in the long run. So anyway, that's my quick little aside and rant on tax loss harvesting and just taxes in general, capital gains in a taxable account, Lucas. Lastly, I would think from an estate planning point of view, Lucas, you should understand what would happen with your taxable account in the event of your untimely death. If, for example, you know the assets would pass to your spouse, it might make sense to put a TOD, transfer on death, designation on that account. If it's already a joint account between you and your spouse, you might want to put a with rights of survivorship, WROS, designation on the account. Or if you'd want to pass those assets on to another family member or a friend, you might want to detail that in your will. So thank you for the good question, Lucas, and happy investing to you.
Here's a quick ad, and then we'll get back to the show.
Serious question. Why do podcasters constantly ask for ratings and reviews? Yes, they do help highlight our shows to new listeners. They help strangers find us on Apple Podcasts and Spotify. It's totally true and a good reason to ask for ratings and reviews. But I have something more important, at least more important to me. I want to know if you like this stuff. I want to know if you like my podcast episodes, my monologues, my guests, the information I share with you and the stories I tell. I want to improve and make your listening more enjoyable in the process. So yeah, I would love to read your reviews. And sure, if you throw a rating in there too, that's great. If you like what I'm doing, please share it with me. It's such a great feeling to read your feedback. I'd love to read your review or see a rating on Apple Podcasts or Spotify. Thank you. And here's the last question today, listeners. Question number 5 comes from Chris. Jesse, thanks for the work you do. There are a few local financial planning firms who I know and trust, and I'm interested in working with them. I've asked them many questions. Thank you for guiding us in what questions to ask. Your article was very helpful. Side note, listeners, the article that Chris is referring to, we will link it into the show notes. It's the questions that I would recommend that any of you go and ask a financial advisor when you're interviewing them. Now, back to Chris. But my question, Jesse, is this. I want to potentially give a third of my portfolio to each of the 3 advisors I know and trust, and get financial planning advice from each. And then depending on performance and the quality of the advice and just how I feel about the relationship, I'll whittle 2 of the 3 of them away over time. What are your thoughts on that? Chris, that's a cool question. And you're certainly not the first person who's had that thought or thought that question to themselves. And I get it. You want to test drive a little bit before you commit. This is a very, hopefully a long-term relationship that you're entering into. And there is that question of, do I know enough as an outsider? Do I know enough between these 3 different financial planners to really make the decision on which one I should go forward with? Or does it just make more sense to spend a few years getting to know each of the 3 better and better and better before then committing to the long-term aspect of the relationship? I totally understand that, but I do think what you propose has way more negative downside than positive upside, way more cons than pros. And I would caution you against it. And to be honest, if I was one of those 3 advisors and I knew that's what you were doing, I wouldn't agree to sign up for it in the first place. I wouldn't partake in your experiment. Because not only would it be probably a bit of a conflict of interest for me to participate for myself, but I also know for a fact that it would be bad for you. You're setting up a situation that's going to be bad for you. And there are a few reasons why. That's what we'll get into here with the meat of the question. You know, the King Solomon baby story, right? The judgment of Solomon from the Hebrew Bible, in which Solomon ruled between 2 women who'd both claimed to be the mother of a child. Solomon orders the baby to be cut in half, pretty barbaric, and each woman receives 1/2. The first woman accepts the compromise as fair, but then the second woman begs Solomon to give the baby to her rival, preferring the baby to live even without her. And of course, that was a sign that the second woman is the true mother, blah, blah, blah. Solomon changes his decree and gives the baby to her. That's kind of what's going on here, is I think the dividing your portfolio and dividing your financial plan into 3 different parts, it's a bit of a judgment test as to whether the folks who you're planning to work with are thinking it through and thinking in your best interests. Getting back to Chris's question, let's just say I was one of Chris's 3 advisors. First, it's going to be challenging to invest Chris's third of the pie when there's a lack of knowledge about what's going on in the other 2/3. We've talked here on the podcast before about the puzzle piece metaphor. Building a plan, building a financial plan, it's like putting together a puzzle. It comprises a lot of different puzzle pieces from all different aspects of your financial life. And it really does help having all the puzzle pieces in order to successfully and efficiently solve the puzzle. I mean, just imagine solving a puzzle without all the pieces. It just doesn't work. If 2/3 of Chris's assets are being invested elsewhere, and I don't really know what's going on there, I don't know how they're approaching the investment problem, I don't know what kind of decisions they're making, what kind of asset allocation is going on, I'm not sure I can do as good a job for Chris as otherwise I could. So that's a negative. That's a pretty big negative downside. Second, for Chris, I'm a little curious what you'd end up doing with the 3 parallel sets of financial planning advice. 3 different retirement dates, 3 different Roth conversion plans, 3 different everything. And the question is, are you, Chris, going to be the knowledgeable arbiter who determines which of those 3 sets of plans is best? Because it does kind of beg a question. If you're smart enough to rank order those 3 financial plans, I wonder why in your interview process you haven't already been able to separate the wheat from the chaff of these 3 advisors. Why can't you already tell which advisor or planner is smartest? Or the question is, if you're smart enough to tell which of those 3 is good, Why aren't you just doing more of it yourself? Why are you offloading it to them in the first place? And I think I might know the answer to my own question there. And the answer there is this stuff can be pretty complex. And you might not be able to tell which planner or plan is truly the best. You'll probably sit there for a few years during this experiment. You'll stress out over a question that you're probably unable to truly answer. That's a big challenge. Instead, and so what I've done there is I've presented you with a problem that you don't really have an answer to, and that's harsh of me to do. But here's the answer. Here's my recommendation. I would ask yourself, do you believe that this person is an expert and their value will be in excess of the fees that you pay? So that's a yes or no question that you can answer for all three advisors. You're not necessarily ranking them 1, 2, and 3. It's just a yes or no, black or white question. Are they an expert? And will their value be in excess of their fees? So it sounds like maybe you said you know them, you trust them. Maybe the answer is yes for all three of them. You know they'd be a good advisor for you. You just don't know which one's going to be the best. Okay, well, take all the ones that you answered yes to, that they're an expert, their value will be in excess of their fees, and then you can ask some softer questions as tiebreakers, such as, which one do I trust the most? Which one do I want to see the most, right? Which one do I want to see once or twice or 3 times a year for the next few decades? Which one has the smartest contingency plan in place if they get hit by a bus? Which one's investment philosophy just makes the most sense to me and my understanding of the investment world, et cetera, et cetera, et cetera. These are some of the questions, Chris, that we talked about in the article that you mentioned in your question that I've linked in the show notes, the 16 questions that you should be asking a financial advisor. So here's another thought for you though, Chris, and a thought that I think should give you some hesitation. If I'm one of these 3 advisors and I know I'm being judged on investment performance, especially over a short period of time, which in the investing world might mean a year or 2 or 3 or 5, then I'm going to think, okay, I've got a 1 in 3 chance of winning. The odds are not really in my favor. If I invest in a simple or boring or mostly index or highly diversified way, then I'm going to expect my performance to be pretty average, right? I mean, that's the whole idea of simple, boring, index diversified investing. We get average market type performance. But in a competition with many different players, average is never going to win. So doing the right thing from a certified financial planner fiduciary point of view, doing the right thing for you, Chris, is actually going to lose in this competition that you've set up. So from a game theory point of view, your competition is going to incentivize me to do what exactly? Well, to take extra risk with your money, Chris, in order to achieve extra returns. That's the only way I can expect to outperform my competitors. I have to take more risks than them. And if they're smart, they're thinking the exact same thing. And then if I'm smart, I know they're thinking the exact same thing. So now it really becomes an arms race as to who's going to take the most risk. That's the nature of the competition that you've set up. And it's clearly something that is not in your best interest. So one of my friends, a listener of the show, Craig, he likes to say, imagine you did the keto diet for breakfast, a vegan diet for lunch, and the Mediterranean diet for dinner. Would you expect good results from that? Assuming you even achieved some of your health or weight goals, you'd have no way of knowing which of those 3 diets was actually beneficial for you or which one was the most beneficial for you. In conclusion, Chris, I would recommend you not pursue that idea. I understand the reasoning behind it. It's just a fantastic and beneficial question for everyone listening to hear the thought process there, because I know for a fact you're not the only person who's thought that. But I would caution you, Chris, against going down that path. And with that, thank you all for listening. If you enjoyed this AMA, go back and listen to past AMAs, which were episodes 90, 86, and 81. As always, thank you for all those who leave ratings and reviews on Apple Podcasts and Spotify. I really appreciate it. If you haven't yet, please go leave a rating and review so that others can find this helpful content. And as always, thank you for listening to the Best Interest Podcast.
Thanks for tuning in to this episode of the Best Interest Podcast. If you have a question for Jesse to answer on a future episode, send him an email at jesse@bestinterest.blog. Again, that's jesse@bestinterest.blog. Did you enjoy the show? Subscribe, rate, and review the podcast wherever you listen. This helps others find the show and invest in knowledge themselves, and we really appreciate it. We'll catch you on the next episode of the Best Interest Podcast. The Best Interest Podcast is a personal podcast meant for education and entertainment. It should not be taken as financial advice and is not prescriptive of your financial situation.